The ET Startup Awards recognize excellence in 9 categories. But before I tell you what those categories are, I'm going to invite Samida Sharma, editor Startups and Emerging Business, The Economic Times, onto stage to moderate this evening's panel discussion. Samida, can we have you on stage? May I also invite our panelists, Smita Deora, co-founder lead. Smita, can we have you on stage? Sumer Juneja, Managing Partner, India and EMA, SoftBank. Sumer. Harsh Jain, co-founder Dream11 Sports. Kalyan Krishnamurthy, CEO of Flipkart Group. And of course, Nitin Kamath, founder and CEO of Zerodha. The amount of net worth on this stage is staggering right now. All right, today's panel discussion is titled The Great Reset, Tracking the Growth versus Profitability Conundrum Amidst the Tech Winter. Samida, over to you.
Check. Hi. Thanks, Suresh. Thanks, everyone, for joining us here today at the 8th edition of the Economic Times Startup Awards. It's been a unique year. We're obviously, like Suresh mentioned, meeting for the second time around. Nitin is a constant. He was there in March, and we were early signs of what is now being called the tech winter was around the corner. VCs were circulating cautionary notes. 6 months down the line, obviously, a lot has changed and very rapidly. We don't have too much time, so I'm going to jump in. We're talking about how this whole reset is going to play out. We're going to weigh in on things like profitability over growth. And we have a very varied set of folks here. I want to start off with Smita. Smita, you're in a sector which has obviously seen a lot of turmoil. It gained from the COVID bump up. And EdTech obviously was actually one of the first ones in India to see a lot of layoffs, reset of businesses. Tell us a little about what is internally right now your memo to your employees, your team, as this must be one of the first downturns that they would have faced. What are you telling them?
See, pre-COVID, the education sector was largely seen as institutions and schools imparting education, and then we had all these technology players who were directly talking to students and learners who were older in age group, whether it was test prep or higher education. I think the exuberance which always surprised me during COVID was the same was getting reapplied to much younger students, which was just, if you speak to any parent, I think it just defies how learning happens for young children where it needs to happen in a physical environment in a school. Technology, hence, for this age group always needs to belong in the hand of the teachers versus direct to students. So I think some of what we saw was a lot of money going towards K-12, B2C edtech, which I always believed was a swing up. It had to come, it had to come down once schools reopened, and that's what we're seeing. For us, the internal memo to answer your question is we are actually in great times now because we have always believed in giving technology to teachers and working in schools. COVID was tough for us because schools were shut. Our internal memo is this is the time when we go out and
But you've done a bit of rationalizing, right? I hear there's been layoffs, etc. at Lead as well.
See, every organization goes through performance, performance appraisals and goes through sometimes some amount of restructuring because you automate things. In a large 2,000 member, size organization, we had some 80, 90 people who left through the performance cycle. That's all that's happened. But at that point of time, media was all about layoffs, so they just wanted to pin everything to layoffs.
We won't talk about the media today. Today is all about you guys. So just shifting focus a little bit, I want to come to, like I said, very varied panel. So two profitable companies, one 15-year-old company which is still making losses, but Kalyan obviously says that he's investing and therefore there's a reason for that. And obviously we have an investor who will bring a different lens to the conversation. But Harsh, I want you to talk a little about how this entire reset works for someone like you, which is profitable but has raised money, there is valuation pressure. How do you kind of balance this whole growth and profitability? Because a lot of founders are telling me today they're fine clocking 20% growth and would rather do that consistently and be profitable. I mean, how does that impact your valuation and overall, what investors think about it?
Yeah, thanks, Amita. So, look, I think we were already profitable before. We've been
Right.
profitable for a few years, so it's not something new
Yeah.
that we're trying to do or flip over and find out. I don't think profitability and growth should be two sides of a coin, right? There are ways to grow profitably as well. And I think that's what we're focusing on. I think the problem happens when you try to hyper grow, when your unit economics are not in place. When you're hoping that you'll raise money today, burn through it, hyper burn through it in 12 months, sometimes lesser, and you feel like, oh, it'll be easy to raise money after that again. I think the minute you have companies that try to raise money with an 18-month runway, which can, be reduced to 12 months if it's going well, or extended to 24 months, at the end of which you're profitable, or you at least break even. I think that whole mindset is now coming into India, and we're going to see a lot more companies with that mindset growing today. We need to have that 2008 kind of mindset where you can't count on funding 6 months, 12 months down the line. You have to build. I mean, we're not the ones like that are private companies like us are actually, we're not Section 8 companies. So we can't be not profitable for forever.
But tell me, how does all of that impact your prospect of tapping the public market, if at all? I don't know, you've never really spoken about it very seriously, but do you think you're kind of then, you would be an equally successful public company with that mindset?
I hope so. I don't think the fundamentals should change if you're private or public, right? Your unit economics, your thoughtfulness in growing responsibly, being self-sustainable, these are things with high corporate governance. These are things you should have even if you're private or public. I think the only thing that we would look at going public if you're solving a problem that exists by going public. I don't think I would ever want to go public just for fanfare or because the market's hot or, that's not a reason to go public for us.
Kalyan, what's your point of view? I mean, were you expecting, you also gained from the whole digital, sort of the bull market of COVID. You did a lot of M&A. You expanded in a lot of new sectors. Did you anticipate this kind of a downturn happening? I mean, you've actually been talking about it for a while. You also, I hear, had a freeze on hiring about 6 months before everyone sort of started laying off. Did you anticipate this, or would you have sort of done it a little differently in 2021?
Yeah, we absolutely anticipated this. I think just to pick on what Harsh also said, in 2001, companies saw a spike in valuation of, I don't know what, 2x to 6x, with some underlying assumptions for the next 2 to 3 years. I think very quickly it was clear that those assumptions are not going to play out, right? Growth assumptions, profitability assumptions, it was very, very clear. So 6-8 months into this year, it was so clear that there is going to be a reversal of all of that. Or people were smart, I don't know, smart enough or savvy enough to raise enough money last year that they don't go to the market and actually grow into those financials.
That never happens, no?
95% of the times it will not happen. I think there will be a couple of situations where it can happen. So yeah, this is going to be a tough next year. I think a lot of people probably hit the market, is my estimate, maybe between April to June next year.
You mean the funding market?
The funding market to raise money, and that's probably the moment of truth for all of us in the ecosystem.
What do you expect? Will there be a lot of them which will find themselves to be overvalued and therefore will have to go for a down round?
Yeah. But then there is some more creativity in the funding market. I think what people do is there is this news. There is, yeah. So you see, all of us have been in this market for several years, and in my previous career, on the last 15 years, this structure was kind of not very common, the convertible structure, where you actually can raise money without pricing around. So I do believe
That doesn't really help, right, Nitin? I mean, what's your view? Saving your valuation for a later discovery. I mean, how does that work?
No, I think, when you're pushed to the edge, you will do whatever it takes, right? As in, entrepreneurs are all fighters, so we're gonna fight it out types. So, yeah, I think right now, yeah, I think entrepreneurs have to do what is right for the business, and if it means convertible rounds, so be it.
But I mean, you obviously have never raised any external capital. You're bootstrapped till today. You're highly profitable. You also have a view from the public markets standpoint. And I remember 6 months back when we were on stage, you did point out that this will be a longish kind of slow period. We weren't very clear. It's actually, I think in India, it's still sort of, we're lagging behind US. And I'll come to Somer to get a little bit of the view from the West. But how do you evaluate a situation like this? Do you actually think it is advisable for companies to just take a valuation which is, say, 20 or 30% lower, raise, and then sort of build for the next 2 to 3 years heads down, or keep saving their valuation through what Kalyan just mentioned, creative ways of fundraising?
Yeah, I don't know if I'm really qualified to talk about this, but yeah.
I think you can talk more freely about this than anyone else here.
Yeah. So see, the thing is, I think the little bit of bearishness I felt, in March, April was because we had seen, a few IPOs not do well, and in the public markets, the memories last much longer than in the private markets, So, and unless a few companies come make money, it was hard to see how a lot of new startups could come raise money from the public market, and the problem with, I think, with the startup ecosystem is that everyone's looking at the public market as an exit, but really it's an entry, right? As in you're getting a retail investor who can take the least risk on your cap table. So you should kind of leave some value on the table for that, right? As in, and that if you look at the last few years, not just in India, across the world, everyone is looking at public market as an exit, and it felt like we've hit the top where I don't think more public investors will get swayed by that. So that's how it felt that we'll probably not have too many IPOs in the future. In terms of if I was in the shoes where if say the next 12 to 18 months is all the runway I have, and I need to survive, I think I'll do whatever it takes. I think the idea is to this whole, I think one of the best things about Zerodha is that every time I sleep, I know there's almost like a 14-15 year runway in my head. That's how much money is in the business. So I know that even if I go, even if business goes to trouble 3-4 years, we're going to be all right. And I think that freedom of knowing that you can get through 3, 4, 5 years is amazing for a founder. So I think the founders should do whatever it allows the business to grow as well. So I think founders have to do whatever it does to raise enough money, and have that cushion. And I think there is, in the startup ecosystem, there's no doubt there is a lot of bloat, and those hard decisions, the earlier you take, I think it's better for the business.
So, Somer, you're the lone investor, so you have to answer for a lot of your brethren. But tell me, SoftBank, obviously I don't even want to get into the kind of stuff that's happened in US tech, even in Europe, and you're kind of now shuttling between London and India. Tell me what, you've also just come back from Milken, so you have a view of what people are talking about, in terms of macros, etc. What do you make of the market? Is there actually a reset, or we're still 6 to 8 months? Kalyan says April is when the reckoning.
So I think there are two things, both globally and India, which we have to recognize, especially for tech. COVID gave us a glimpse of what tech adoption will look like in fast-forward pace. But I think when the world opened up, we've all realized, whether it be shopping, whether it be food delivery, whether it be ed tech, old habits die hard. I think that's where we will eventually get to. But I think like what Harsh was saying is we can't fast forward that, and we should be sensible about it. Second, if you see from the global financial crisis, we've had 0% of very low interest rates. So the cost of capital and the money floating around in the world, especially in growth equity, has been enormous. And so the bar to invest, the bar to do diligence, the pace of investment has been very free. And I don't blame the entrepreneurs for taking advantage of that. If someone's giving you a value, why wouldn't you take it? What's going to change now is you have come back to pre-COVID, so growths have to be tempered down. Interest rates have gone up substantially. Cost of capital has gone up substantially. This will go into all our models, and therefore the valuations have to be reset. They've reset dramatically in the public markets in India, in tech, and in the US, and that has to follow through on to the private markets. I think 23 is going to be tough. I think the companies which sort out their unit economics and have an appreciation of what's going on and realize very quickly what they have to do will be in a better position. The others who are not focused on the unit economics and not taking the tough decisions, I think will go through a very tough time.
But are you seeing that happen in India? Because when I'm talking to a lot of investors, they're still saying that founders are holding on. It's still not happened the way it has happened in the US. And I mean, Harsh, Kalyan, you guys can also chip in what
So
you're
I
hearing
think
from the market.
that's the difference, right? I think what Kalyan said, I think people got overcapitalized in 21, so they have the comfort to wait it out. I sincerely believe the ones who don't realize it quick enough, it's in the West, it's happened in Europe, it's going to come to India. I think if you don't realize what your true value is given the new cost of capital, and you keep pushing it out, I think that's a dangerous game to play.
Harsh, you obviously have mostly done a lot of secondaries. So I don't know what's your sort of take on this, but what would you tell founders who are sort of at the crossroads? They don't have more than 6 to 8 months of runway. How would you deal with a situation like that? Because I think constantly Indian founders tend to hold on to valuation. I see in layoffs as well, they're sort of more piecemeal, unlike what you see in the US tech, which is like 10%, 12% of workforce gone. Those hard decisions don't come by very easily for founders here. Why is that?
Yeah, honestly, if I was a founder with 6 months of runway, without having 100% confidence of breaking even, I would be panic, right? There's no other way of saying that. And I would take every hard decision right to the bone as much as I can. I know this is probably not the best place, but we need to stop caring what the media says about, oh, I've only done 10% layoffs, but 20% layoffs. Look, as a founder, our job is to make money for the business, to earn the right to continue working on our passion. We just want to do what we're passionate about. And if that means layoffs, mass layoffs, whatever it takes, that is your job, your fiduciary responsibility to your board, your investors, your employees who are hopefully your shareholders. You have to do whatever it takes, whether it's 50% layoffs, whatever it takes. Cut your marketing budget, cut your benefits. Look, I know I may be a bit of a dinosaur, but I just believe that there's
Why would you be a dinosaur?
No, I just believe that there's this whole set of people that push all kinds of remote working, flexible working.
Like that,
Look, I think we have to change the world. We also have work from home. We also have unlimited leave. But there has to be given with guardrails, with moderation to solve a problem. It can't be given to be cool. Right? There has to be hard work and perseverance.
I want to ask Kalyan. I mean, he runs a very large company. What's your point of view on that?
One thing is,
And I want to just slip in another question. What does all of this mean for a company like yours, which is 15 years old? You were very seriously contemplating an IPO. Does that sort of go on the back burner, or do you still kind of want to turn in profits, go public?
firstly on the...
Kalyan, don't look so stressed, yeah.
No, I'm not stressed. I'll first answer the previous question here, right? I think we need to come together as an ecosystem to a place where concepts of down rounds and all are not seen as...
But why? I mean, we say that we've evolved, etc., in fundraising and valuations. Why is it that
Yeah, you look at the maths, right? Let's say somebody does a down round of 33%. Let's say they do it in June of next year. If you just look at the CAGR of their valuation, it will still be 60%. A 5-year average of their valuation growth, it will be 60%. Just to let you know, Flipkart's CAGR of valuation is 20 to 25% even today. It's perfectly fine to embrace a concept of a down round, restructure your company.
you guys did it as well?
Yeah, I actually was part of the architect of that, I think 16 or 17, right? Big one. I think we took it down by 30% and we reset the whole cap table and we grew from there. So it's not a problem. And I think, once again, you should also support it as the media, like Harsh said. I think
Was there for us to support? I mean, we'll write factually whatever it is. We can't say, oh, great, you did a down round. I mean, that can't be the thing, right?
yeah. The second,
You're right, great. The ecosystem's matured and we've done a ground round.
It is all there to be seen. I mean, once a company goes public, performs well, it's all transparent, right? I mean, there's nothing for me or for anyone else here to say.
Yeah, so coming to the other question, I don't entirely subscribe to this view of a company performs well, does an IPO. That's not the way I look at an IPO also, right? First of all, I also never committed to anybody that we were...
No, you didn't. No, you didn't.
We did not, right? So there are reasons why companies go public. There are 2-3 big reasons, right? First of all, of course, it's a fundraising event. Let's not forget that. It's a fundraising event at the highest level. Second is, there is a market-driven price discovery. Right? It's a very, very transparent market, so the pricing is very vibrant. Number 3, people get liquidity. These are 3-4 big benefits of an IPO. On the flip side, you have to start sharing how you run the company and manage the company with investors. You don't control the company's future very clearly on your own, right? So my own philosophy here is that if you don't need the first 3 pieces, if you can manage those through a private round, I don't necessarily see why we would do a public listing.
I
Yeah.
guess it's easier for you, but you have a lot of companies who've raised capital. And what Nitin said, I mean, the only way for them to exit is via going public. But you know, since we're talking about IPOs, and I want to ask Nitin. I mean, I was just asking him before we entered the room. There are a lot of people who were trying to actually very seriously go public, don't want to be branded as startup IPOs or tech IPOs. Is that something that you've also got as feedback from, you know, public market investors, especially retail investors who didn't quite understand and went with the euphoria of last year?
Not really, actually. You know, so but I can like, I know, being a regulated business, I think both RBI and SEBI is kind of looking at anything that seems tech, startup-y with through a lens. So I think the pressure there has increased. But also I think the retail investor is also quite mature. I mean, if you see the conversations, etc., that happen, you know, on online communities, you know, people are talking about, you know, valuations, etc. You know, and not really. I don't think it'll be as easy to IPO as it was last year, for sure.
Yeah.
Right. And the thing is, the thing about retail investors is the you know, all those IPOs, all the tech IPOs, the retail subscription wasn't too much, right? I mean, it was just 15 to 20% at max.
Yeah.
Right. So most of it was actually institutional investors. So where the thing about retail investors is, what happens is, you know, if a company lists at, say, 100 rupees, and it comes to 70 rupees, that's when retail gets sucked into it, right? Because, you know, they're kind of benchmarking an X price as the right price for this thing, and then as soon as it becomes cheap, you know, you think it's become cheap and let me buy it. So I think retail lose more money when a company lists at a certain high price, and then it starts its downward journey.
Yeah.
And I think the biggest case in point was actually Yes Bank, right? As in, when the stock went from 400 to 10 rupees, it just lost like crazy amount of wealth, because every time it came down 100 rupees or 50, you know, like 20, 30%, you had like a new bunch of investors selling their silverware and trying to buy more of Yes Bank, right? And I think one of the things that has happened when some of the startup, you know, the tech IPOs over the last 2 years of listing, is that a lot of people have gotten stuck on the downward journey, you know. So it's not like they got into the IPO.
Yeah.
So there is bad taste, for sure, you know, saying, you know, there is no way to make money from these companies.
We've been joined by Honorable Union Cabinet Ministers, Mr. Piyush Goyal and Mr. Ashwini Vaishnav. Just wanted to go back to Smita. We have about 4-5 minutes left. And just wanted to ask each one of you, I mean, if there was something you could do differently as a founder, you know, in the COVID period between 2021 especially, what would it be? And how would you sort of, you know, those calls, how differently would you take them?
To be honest, I wouldn't do anything differently. And in fact, I think to build off what Harsh and Kalyan were also saying, I think as founders or as entrepreneurs, our big responsibility is towards the problem that we're trying to solve or towards our passion. It's not towards valuation. Valuations are milestones that happen and people invest in our journey at certain valuations. And eventually, if we make money for all the shareholders, we're good. So it doesn't matter, you know. And I think in that context, if I see, I mean, we were amongst the, hopefully the 5% who raised money, recently, and, you know, are on our path to profitability. So I wouldn't do anything at all. I would just continue to say what I used to say before, specifically in the space of education and edtech, that, this exuberance around K-12 direct-to-student edtech, I think, is what is also coloring the edtech space, where some people are now realizing that those were not strong business models. And I think as long as we sort of correct for that in the market, that would be great to see.
So, just one question about, when we talk about the reset, is there a reset also happening in the investor community in terms of the outcomes that you'll see out of India? Because if you see, 2021 was all about unicorn rounds, 100 unicorns, etc. But is the market really ready for those kind of outcomes, or is India really more of, profitable companies, 200, 300 million outcomes, going public even at, $1 billion, and maybe not an $8 or $10 billion?
No, I think the outcomes in India, so if you take the Indian stock market, it's about a 3-odd trillion market cap. Let's say we get to tech, and tech broadly gets to 20 to 30% of their market cap in 10 years. I think we'll have very big companies in tech listed in India. I'm not worried about the scale of the outcome. I think it's the timing you put on it, on when will they get there. Like I said, I think we were...
It's going to take longer.
It's going to take longer, and that has to reflect in the valuation. And I think investors and founders have to realize that how capital efficient we want to make the company, and how founders should be focused on profitability, like people here on the panel have shown.
Harsh, Kalyan, you guys want to just closing remarks on, when do you think the worst is yet to come in India in terms of valuations, in terms of corrections, layoffs, and the overall reset?
Absolutely. Next 12 to 18 months is where we'll see a lot of turmoil, volatility, and I think after that things will be much better. So people should focus on opportunities and also surviving this period. I think it's a very big thing.
How are you preparing for it, Harsh?
I have a slightly contrarian view about, maybe I'm an optimist as an entrepreneur, but I believe that relative to the world, this is one of the first times where we're seeing India has a chance to grow and has a capacity to grow with the advent of a lot of things, with all the government initiatives, with 5G, with the amount of Indians getting online yet, the UPI, the rails that we've been set in this country. I believe that this might be one of the first times in tech history at least that we don't just follow the US. I believe that, of course, we will have some knockoff effect of the US, but I believe in the next 6 months, we will start seeing relatively much better growth in India before that kicks back in the US.
No, that's something that a lot of people are talking about, the macros sort of being in the favor of India, but we'll sort of watch and see how that unfolds. Thanks all of you for participating in this panel discussion. Hopefully it was insightful.